In this video, let's have a look at the types of assessments, the notice of assessment. Now, on types of assessment, we have self-assessment. Then we have the Commissioner General's assessment, which has 3 respective divisions. As regards A, preemptive assessment, B, adjusted assessment, C, provisional, that's best judgment assessment. Now let's look at self-assessment. Self-assessment is a regime that allows taxpayers to make an estimate of their anticipated income and the tax payable on that income. Here, the taxpayer is responsible for accurately computing and reporting his or her liability to the tax authority. However, the law allows a threshold margin of up to 10% of the correct tax payable. The taxpayer may revise the estimated assessment before the end of the basis period. An installment payer shall divide the tax on self-assessment by 4 and pay on quarterly installments. The timing of installments payments depends on the basis period of the installment payer. An installment payer shall pay tax in installments as follows. As regards the basis period I, where the basis period of the taxpayer coincides with the government's fiscal year, it behoves on the taxpayer to pay on or before 31st March of every year, on or before 30th June of every year, on or before 30th September of every year, and on or before 31st December of the basis period. So herein lies the installmental payments of the installment payer. In any other case, the taxpayer is to pay on or before the 3rd month, on or before the 6th month, on or before the 9th month. Now, I stated we have the types of assessments. That's the self-assessment and that of the Commissioner General's assessment. Now we move to 2, the Commissioner General's assessment. And I broke it down into A, preemptive assessment, adjusted assessment, and provisional or best judgment assessment. The preemptive assessment, that's Section 38 of the Revenue Administration Act 2016 Act 915. In some circumstances, the Commissioner General may raise an assessment earlier than when the taxpayer is required to file and pay taxes in order to ensure that tax revenue is not lost. The following circumstances may occasion a preemptive assessment. 1. When the taxpayer becomes bankrupt. 2. When the taxpayer is wound up, or when the taxpayer goes into liquidation, or 4. When the commissioner believes on reasonable grounds that the person is about to leave the country indefinitely, or 5. When the taxpayer is otherwise about to cease activity or business in the country, or when the taxpayer has committed an offense under the tax law. Also, when the taxpayer with regards to the Commissioner General, consider it appropriate, including when the person fails to maintain adequate documentation. The Commissioner General may, instead of making a preemptive assessment, accept from a person security for outstanding and future tax liabilities as the Commissioner General considers appropriate. The Commissioner General shall use best judgment and information reasonably available in making a preemptive assessment or fixing the amount of security. A preemptive assessment may be for a period or with respect to an event or a subject matter that the Commissioner General may specify in the notice of assessment, and unless the Commissioner General specifies otherwise in the notice of assessment, a preemptive assessment does not relieve a person from the obligation to file a tax return or otherwise report a taxable event as required by a tax law. The filing of a tax return, including where the filing of the return results in a self-assessment, does not affect a preemptive assessment. Now, Notice of Assessment, Section 40 of the Revenue Administration Act 915, where the Commissioner General makes an assessment under a tax law. The Commissioner General shall serve a written notice of the assessment on the taxpayer. The notice of assessment shall contain the following: A. The name of the taxpayer. B. The taxpayer identification number, that's the TIN. C. The assessment of the tax payable by the taxpayer for the period, event, or matter to which the assessment relates. D. The amount of tax remaining to be paid after any relevant credits, reduction, or prepayments. E. The manner in which the assessment is calculated. F. The reason why the Commissioner General has made the assessment. F. The reason as the date by which the tax is to be paid, and the time, place, and manner of objecting to the assessment. So the Commissioner General use adjusted assessment. The Commissioner General shall use best judgment available in making an adjusted assessment. The CJ, that's the Commissioner General, shall not adjust an assessment that has been adjusted pursuant to a decision of a court unless the decision is vacated. An assessment ceases to have effect to the extent to which it is adjusted. This means the adjusted assessment supersedes an earlier adjustment. Herein, the CJ, that's the Commissioner General, may make an assessment at any time, including and adjusted assessment where the Commissioner General discovers a case of fraud or willful default or serious omission by or on behalf of a taxpayer. Now, the Commissioner General has some powers here. An original assessment expires 6 years from the date on which the Commissioner General was first entitled to make the assessment. And adjusted assessment expires 6 years from 1. The due date for filing the tax return that gives rise to the assessment, or if later, the date the tax return is filed where a self-assessment is adjusted. 2. The date on which the Commissioner General serves notice of assessment on the taxpayer where any other original assessment is adjusted, or the date in respect of the return or notice of assessment to which the adjusted assessment relates. Now, on assessments, there are times the Commissioner General needs to use best practice. Let's make a provisional assessment. So the Commissioner General may make an estimate of the tax payable by an installment payer for the year of assessment, where the Commissioner General, by notice in writing, has specified that that person is not required to submit a statement of estimated tax payable or fails to submit a tax return. Notice of Assessment, Section 40 of Act 915. 1. Where the Commissioner General makes an assessment under this Act, the Commissioner General shall serve a written notice of the assessment on the taxpayer. 2. In addition to any requirement of this Act, the Commissioner General shall state in the notice of assessment A. The name and tax identification number of the taxpayer, B. The tax assessed by the Commissioner General to be payable by the taxpayer for the period, event, or matter to which the assessment relates, C. The amount of the tax remaining to be paid after any relevant credits, reductions, or prepayments. D. The manner in which the assessment is calculated. E. The reason why the Commissioner General has made the assessment. F. The date by which the tax is to be paid. And G. The time, place, and manner of objecting to the assessment. Well, this is an illustration. The Ghana Revenue Authority is in the process of abolishing the provisional assessments under Section 37 of the Tax Administration Act 2015, Act 915, as amended, and instead fully rolls out the self-assessment to all taxpayers at the large taxpayer office, medium taxpayer offices, and small taxpayer offices. As a tax consultant, you have been invited by the Association of Ghana Industries to speak to its members on the topic, the merits of self-assessment. You are required to state briefly only 5 of the benefits or importance of self-assessment. So these are some of the reasons why people opt for self-assessment. 1. It is an important tool for the realization of voluntary compliance by the taxpayers. 2. It assists taxpayers in tax planning and cash flow management. 3. It relieves both the taxpayer and the tax administrator from the long and arduous task of objections and the determination processes which sometimes foster conflicts. And 4. It endangers trust between taxpayers and tax administrators. Additionally, tax assessment through self-means is relevant because the Revenue Authority may be saved from the administrative costs associated with provisional assessments. Also, both taxpayers and Revenue Authority may be saved from the inconveniences of overpaid taxes and the need for refunds. Finally, it assists to curb the tendency for unofficial negotiations between taxpayers and officials of the Ghana Revenue Authority for self-gain, or any revenue authority in general for self-gain. Look at taxation as an instrument of economic stability. The underdeveloped countries are very susceptible to 3 sources of instability, which results from the nature of their economy and the logic of accelerated economic development. So instability caused by world market development, another instability due to cyclical deficiency of effective demand in the short run, and instability caused by inflationary pressures. The underdeveloped countries are more vulnerable to the effects of international cyclical fluctuations due to an unbalanced nature of their economic structure and heavy reliance on the export of primary products as a source of their national products. Therefore, will tend to exercise a predominant effects on their national income through the medium of the foreign trade multiplier. Equally, as the underdeveloped countries export primarily raw materials, they import the finished manufactured goods from the developed countries, and in the event of an international recession, the underdeveloped countries exporting primarily primary products find that the resources in agriculture and some other primary immobile in the short run and often continue to produce the same type and even qualities of outputs as before, but as the demand for these products are inelastic, it leads to a fall in the price of these products in the international markets in these countries, which affects them adversely as their own consumption requirements are very small due to their subsistence living. Then we have the specific fiscal instruments like export taxes. Export taxes are more useful as stabilization measures than aggregative fiscal instruments such as a general sales tax and income taxation. These specific tax measures are more flexible in adjustments than income tax and can also single out the export sector of the economy and counteract the destabilizing influences that arise from it. Besides, they are relatively simple to administer and difficult to evade. But the contribution of export taxes to internal economic stability and thus economic development can be of great significance only if the underdeveloped countries are able to resist a high propensity to import consumer goods, especially luxuries, and have the necessary skill not only in the manipulation of export and import taxes, but also in timing the changes and channeling the proceeds for promoting their economic development. Furthermore, the stabilization objectives of taxation should also aim at maximizing the level of aggregate saving by applying a cut to the actual and potential consumption of the public at large. This stabilization objective should aim at curbing the conspicuous consumption of the rich and force them to save for capital formation, which, if maximized, should break economic stagnation and lead the country on the path of rapid economic growth. Also, another objective of the stabilization policy of taxation should aim at protecting the economy of an underdeveloped country from the evils of inflation and depression, as the underdeveloped countries have usual susceptibility to inflationary pressures. Stagnation is regarded as too heavy and unacceptable a price to pay for achieving stability in prices. At the same time, large-scale inflation as a means of promoting the economic development of the underdeveloped countries is beset with so many evils. Thus, the taxation policy for a developing economy should aim at curbing inflationary pressures inherent in a developing economy, as in such countries. There is always an imbalance between the demand for and supply of real resources. Furthermore, during depression, taxation along with other fiscal policy must operate in coordination with each other to offset it. Thus, taxation policy along with other fiscal policy measures are ideally suited to check inflation and depression in a developing economy. Taxation will be reduced in deflationary situation, while during inflationary situation, taxation will be increased. If inflation is not controlled in time, it can undermine the very process of economic growth and development. As such, a suitable taxation policy for an underdeveloped country should be designed as to curb the demon of inflationary and deflationary situations which can prove ruinous to an underdeveloped economy.